It's a big moment. Interest rates have just been cut. Is this mission accomplished on inflation?
No. Of course, we could, as a central bank, we will say it's never accomplished, actually. But no, this is an important point in time because we have seen the inflation evolve as we hoped it would, in the sense that the big global shocks have really played through now. And so I think now is the right time to take this step to take some of the restrictiveness out of policy by making this cut.
Can households expect interest rates to get back down to the levels they were a few years ago, so near zero?
Well, I think it's important to understand what caused rates to go to net zero. After all, if you look at history, recent history, that is not a normal state of affairs. So what caused that was a number of huge global shocks. So it started with the financial crisis back in 2007-9, and we really went to zero in sort of 2009 as a consequence of that.
So people shouldn't necessarily, unless there's something kind of catastrophic that happens.
I think that's a
they
reasonable
shouldn't expect it to get back down.
Expectation. Say, I would not normally expect rates to be at zero.
Can people kind of reasonably expect, given that rates when they came up, they were going up successive meetings, 14 meetings, one after the other, after the other, after the other, after the other. Can they kind of reasonably expect that might be the case on the way down as well?
Well, I would say we're dealing with a very different situation now.
So probably not?
I would caution against that.
Right.
Because the situation we were dealing with on the way up was these huge global shocks hitting one after, in very close succession. If you think about COVID, particularly the coming out of COVID, and then you think about Ukraine, they were all, there's almost no, well, there really isn't any gap between them actually. And so we were having to respond to this huge takeoff in inflation caused by those shocks. Now, we're in a different situation today because we're dealing with the sort of, if you like, the sort of, the after effects of those shocks. And we're at much lower levels of inflation. So we're back to a more normal situation, if you like, of saying we need to calibrate policy and to set policy to take that sort of that remainder of domestic effects out, but it's a much shallower path in that sense of inflation. We're dealing with sort of sticky leftovers, as it were, in that sense.
So in some, probably not down to 0.5 or whatever percent it is, probably not down one meeting after another. That's useful for people to understand that. But looking at kind of where we are now, so inflation is back at 2%.
Yeah.
That's on target. Can you kind of give us a sense of how much of that fall, down from double digits to 2%, how much of that was down to anything the Bank of England actually did, rather than international factors or energy prices or the rest of it?
I think that had we not acted as we did, then the risk was that the domestic effects would have been larger. Because there would have been, quite reasonably, there would have been more pressure to try to compensate for the effects of those shocks in price setting, wage setting. And that's where we had to come in and make policy restrictive.
Final thing to talk about, there's a new government, new Chancellor, actually former Bank of England employee as Chancellor. They've got a new plan as well, including some bits that they've told you about, including 5.5% pay settlements for public sector workers. That, to a lot of people, they'd look at that and say, that sounds kind of inflationary. That sounds like the kind of thing that you're quite nervous about in future. So is it completely uninflationary, or is there at least a bit of inflation in decisions like that from the Chancellor?
We tend to look at private sector wages as the sort of leading edge because they have the most direct, immediate impact on the productive economy. Now, public sector wages, of course, do have an effect. They can cause competition in the labour market, they can have a signalling effect, and they put demand into the economy because obviously people benefit from those increases. Now, we'll wait to see because we will only have the full sort of package once the Chancellor gives the budget on the 30th of October.
So it's too early to have a verdict on this?
I would, however, say that if you get a very sort of rough envelope out and do a back of the envelope calculation, and by the way, you've got to bear in mind that, of course, this is not 0 to 5.5. This is from what was already expected, and we've already been factoring in terms of what was expected in terms of this wage. This
a bit higher than maybe than you were expecting.
It was a bit higher than was put into the previous budget. But honestly, if you do that very sort of slightly abstract back of the envelope calculation, you get a very small number for inflation. It's in the sort of second decimal place range.